All right. Hey, everyone. How's everyone doing today? Just want to get a quick sound check. Make sure you guys can hear me. If I can get a quick hello in the chat room. You guys should be able to see my slides. Hey, Ankit, how are you? Great, cool. All right. So I want to welcome you all. Hey, Carlos. Thanks for joining me on a Sunday for another Greenbridge Investing Educational Webinar. Urzo, hey, how's it going? So I'm coming at you from the greater New York City area. You know my bad joke. I don't know why they keep calling it greater. Anyway, it was something interesting. The reason why I even bring that up, hey Lewis, the reason why I bring that up is because I was looking through the registrants for the webinar because it has the location of where everyone's from. And you know, you have the usual global crowd coming from different countries. But one that really stood out that I was like, wow, was we had someone register from the Isle of Man. Does anyone even know where that is? The Isle of Man. I mean, that's where men come from. That's crazy. Someone knows who I am at the Isle of Man. Anyway, and I just thought it was funny. The Isle of Man. That actually, it's a tax haven. Actually, that's the only reason why I'm familiar with it is because they have these really attractive tax incentives or whatever. Oh, okay. Cool, Simeon. Yeah, the Isle of Man. Anyway, I just thought that was funny. Anyway, okay, cool. So I want to thank you all for joining me for today's webinar. We're going to talk about how to trade classic chart patterns. Now, there's a difference between classic chart patterns and other types of chart patterns. All right, now, you may not be familiar with things like harmonic patterns, but those are chart patterns as well, but they're not classic. They're actually more modern, okay? So, okay, cool. All right, so again, I want to welcome everyone. Also, so let me get this thing started here. I am doing something a little unusual today. I'm broadcasting on YouTube. So I want to see how this works, simulcasting, how this works. Anyway, so this is for educational purposes only, obviously. For investment advice, please consult a licensed investment advisor. Now, let's get into the charts here. Let's get into the presentation. So, forgive me if I'm a little off. I have a lot going on here. Bogus, great. I'm here to answer questions. So the way this webinar is going to go, I'm just going to let you know real quick. I'm going to try to keep this at about 45 minutes, okay, for the presentation part. I'm going to go through some slides. We're going to look at some charts. And then I'm going to do the 15-minute Q&A. Now, I want you to ask questions as I'm doing this. You know, feel free to ask questions, put them in the channel, and if I can't get to them while I'm in the presentation, we'll get to them during the Q&A. All right, so let's get this thing started. One thing I want to mention real quick is, you know, right at the head of this thing is our recent trades. Okay, because a lot of people, they come to Greenbridge, but they're not exactly sure what we do. Well, we send out trade signals by text and by email. We have portfolio ideas that we send out by email as well. And we have a chat room where we have a lot of insight and analysis that we share each day. Now, it's me and it's Andrew. Now, I show this table here, which you can find in our performance tab on our website, because I want people to see some of the positions that we've taken recently and how most of them reached their first target. In fact, today, Bitcoin, this Bitcoin trade, all right, from 92, no, that's the old one. We have another one in here. The one from 92 and a quarter. Is that one in here? It should be. Yeah, right here. Okay. This trade, all right, from 92 and a quarter, that was taken on June 28th. Now, I just published this on TradingView, like it's behind me. June 28th, and it reached our second target today, or overnight. Our first target was 96.75. Our second target was around that 10.150 area. We had to hold that thing for a month. So I bring that up, and it's an important thing to understand because these are swing trades. They don't play out in a day. They can, it's possible, but it usually takes a few weeks, even a month, okay? As you can see with some of these trades. Also, our risk is very tightly controlled, as you could see as well. So I just wanted to give you an idea. We also cover stocks, Forex, CFDs, and we even do options. All right, everyone, so enough of that. Let's get into the webinar now. By the way, if you're watching this on YouTube, hey, DJ, I got DJ, why aren't you in the chat room? Anyway, I got DJ on YouTube. Hey, Arthur, Campesh, hey, guys. So guys, again, you have questions in the YouTube channel, just put them in there and then I'll check the YouTube channel. Keep in mind, I have a bunch of different things going on here, so I'm looking at a lot of stuff. All right, so let's get into the classical chart patterns. And again, I want to thank you all for joining me today. So here's the thing. So you've heard of all these different patterns, right? How many people have heard of the cup and handle? Just give me a yeah in the channel. Have you heard of the cup and handle? All right, how about the head and shoulders? We've all heard of that one, right? The head and shoulders. Okay, great. Those are all classical chart patterns. But just because a pattern appears doesn't mean you always take a trade, okay? And what I want to address in this webinar is the behavioral aspect of these patterns. What is going on inside the pattern? Why does the pattern develop the way it does? And how do you evaluate these patterns in a way that can produce some sort of consistent outcome or consistent result? There's a lot of value in these patterns. Now, hey, welcome. So here's the areas that we're going to basically, before we get into this, I want to define these terms right here, because sometimes these are very vague. Okay, so trend. What is a trend, right? Trend can be on a 1 minute chart. You can have a trend on a weekly chart. All right, so what trend are we talking about? When we're looking at these patterns that I'm going over here today, we're talking about the daily time frame, or basically the trend, the more recent trend that can be evaluated on the daily time frame. So keep in mind, on that daily time frame, there may be a couple of bearish bars, right? If you pull up a 5 minute chart on those bearish bars, you're going to say, oh, but the trend is bearish. The trend isn't bearish on the daily time frame. That's the scope that we're going to stay within here. No smaller time frames, because these patterns can appear across any time frame. There's a point to this, and that's why I'm making sure that we're all on the same page. So we're going to be evaluating the daily time frame. All right. Trend obviously, is part of that, and there's three modes of trend, as you know: bullish, bearish, and range bound. Okay, which is basically lack of trend. So it's important to understand those terms as well. And what is a fractal? Does anyone know what a fractal is? Real quick, don't go Googling it. All right, can anyone tell me what a fractal is? And it's okay if you say no. So a fractal is actually a term that I learned from Elliott wave. When I was learning Elliott wave, fractal basically means a shape within a shape. So you have a collection of shapes that make up a larger shape. So a good example of a fractal, or they call them robust fractals, would be like a head of broccoli, right? So if you take a little branch off of the broccoli, it looks like the larger head. But if you make up all those little heads together, it's one big head of broccoli. Or a branch on a tree, right? If you break off a little twig, it looks like basically a replica of the tree, just a tiny version. But the whole collection of those little branches and twigs and everything else make up a tree. That's what a robust fractal is. And it's important to understand you can have these patterns within patterns. And that's an important thing to distinguish, because you can have a double bottom on a 1 minute chart, but on your 30-minute chart, it's a pin bar. Okay, so you need to understand that. I'm not going to talk about candlesticks in relation to this. We're just going to focus on the patterns. Okay, right. It's exactly right, Ankit. So you guys know, I'm just going over some basics here for people that may just, be new at this, and I want to make sure that everyone's on the same page, because if I go off on some, on some tangents, at least you'll be able to follow along. All right, so that's the first thing. Now you see here I have book and I have title. So I want to point out a book that was written a while back. It's called Technical Analysis of Stock Trends. Okay, I don't have the title here on the slide, but I'll type it in on the webinar channel here if I can. It's Technical Analysis of Stock Trends, okay, by Edwards and McGee. This book was written, the first edition of this book was published in 1948. Okay, what does that tell you? 1948 was basically the first. I'm pointing out this book because you're reading that book? Great. That book was the first book to point out these chart patterns and really explain them in an official way, right? So these chart patterns have been around, in 1948. So technology has changed a lot since then, obviously, but the patterns are still with us. Why is that? Why is that? The reason is these patterns are they're what's the word I'm looking for? They're basically a reflection, okay? Right, Erzo. They're a reflection of human behavior. Human behavior, I don't care how great the technology we have, you can have the best computer in the world, the fastest news, blah, blah, blah. Human nature stays the same. That's why these chart patterns are still working, or they're still developing, because it's human nature. You're watching human nature on a chart. Money is an emotional thing for people. People hate losing money because it means a lot of things, like, you know, you can't pay your rent now, your wife is going to leave you, all this other stuff, right? Losing and making money means, hey, now you can tell your boss to, you know, shove it, and, you know, you can buy that new car you wanted. So there's a lot of emotional things around money. So that's why these emotions express themselves in the market when people are buying and selling. And you have to understand, the market, for people that don't understand the behavioral aspect of the market, markets are driven by two things only, and that's greed and fear. Those are emotions. They're irrational. That's why you can have a stock that has a great earnings report and it sells off. You're like, but I don't understand. Logic says that the good earnings report, the stock should be going higher. It's going lower because there was something in that whatever that scared investors, so they're getting out. They don't care how good the report is, right? So that's why chart patterns can help us get a sense of not only what the herd is feeling now, but how they're most likely going to change in the near future. And that's what we're interested in, because we're looking for opportunities. And that's where opportunities are. All right, so I covered all that. So make sure that book from 1948, I pointed it out not just because, you know, it's a good book to read. This was a CMT book, by the way, that they made us read. But I want you to know that these patterns have been around for a long time. So let's get into the patterns. So first I'm going to show you the blueprint of the pattern. And then we're going to go into an actual chart. So Lewis, do you have the author name or any book? Well, that book, that particular book is a good book. The Technical Analysis of Stock Trends by Edwards and McGee. There's another book, I can't think of the name of it right now. I think it's called Technical Analysis for Professional Analysts or something like that. I can't remember, but it's a very good book because it really covers a lot of different topics. But the book that's relative to this webinar really is that book by Edwards and McGee. And obviously they have newer versions of the book, but they cover a lot of detail as far as technical analysis and chart patterns, okay? So, oh, cool, JJ. Yeah, whenever you get a chance, I appreciate that. So let's talk about the double top, and let's talk about this from a behavioral perspective, because we all know what a double top looks like, okay? Cool, thanks, Johan. So a double top basically is a price, a resistance area, right, that's reached twice. Now, I put a question mark here on the second top. The thing is, when you're new at this, you're looking for precision, right? So you say, oh, the double top, you know, this price here was $15.05, and this price here was, you know, $16. So that's not a double top, it's a breakout. No, no, no. It doesn't have to be precise. It just needs to be close. It could be slightly below. Okay, this could be $15, this could be $14.50 or whatever. It's still a double top because it's the behavior that matters. What occurs at a double top from a behavioral perspective is selling activity appeared one time, historically, previously. That's what I like to call a historical resistance because it's on the chart, rather than a proportional resistance, which is something we can measure in advance, right? So we have this historical resistance. Selling activity came in at that point, and we want to know if it's going to come in again. The thing is, you have a point of reference. This is now a starting point. And we're going to look at an example of this here in a moment, a real example. But you have that reference point, okay? And now the question is, does the selling activity come in again? Now let me ask you guys a quick question. Let me see who's listening here. Who thinks, or do you think when a market reaches a resistance, do you think it sells off faster than if a market is sitting at a support? Which do you think is faster? selling off at a resistance or buying off of a support? Which process do you think is faster? Resistance, Pal, good answer. Pal comes to all my webinars. He knows all the answers. Simeon, resistance. Okay, why resistance? Why do you say that? Why do you say that? Why does resistance, why does selling react faster off of a resistance level? Yes, Pal, you got it. You got it. Well, fear of loss is a greater motivator than fear of missing out. So if you're at a support, you're like, oh, well, I'll wait till, I'll hold off a bit and I'll wait till the price looks better and then I'll buy. When this thing is at a resistance and you're about to lose money, you're out. There's no, well, I'll see how it goes. You're out. People, especially people that know what they're doing, they're out. Okay? So that's what it is. It's the fear of loss is greater than the fear of missing out. So that's why we've had many situations, like with Bitcoin and other markets that we look at, where price will sit at the resistance and it won't sell off. We'll get a pin bar, but it won't follow through. And what do? I come out, on TradingView or wherever else in the chat room, and I say, this market's still strong. Why? Because a market should sell off quickly at resistance. It should not linger. If it lingers, that's a hidden sign of strength. Now, people like to give me a hard time about that, but we've seen it over and over again, right? So that's just an important thing about double tops. When you get your confirmation, and I'm not going to be talking about confirmation today, but when you get the confirmation, it should follow through. So let me ask you this. Let's say you get the confirmation and you get short, okay? Let's say you get a pin bar, bearish pin bar, you get short, takes out the low, you get short. The next candle is a inside bar and it's green. Is that the kind of candle you want to see? If this thing is weak? No. No. This thing should not be indecisive off of such of a level. So that tells you right there, oh, I'm probably wrong. I should probably tighten my stop. I should probably be prepared to get out because this thing, I should see a long bearish candle. That's what you should see after a pin bar. And if that candle is not progressing, and again, I'm talking about the daily time frame. So you're watching this thing over the whole day, and if that is not progressing and you're coming to the close of the day and it's green, what's this? Where'd these buyers come from? This is not what I'm in for. So that's how you know to adjust. And that type of exercise, when you know what to expect and the market's not delivering, that's when you become faster at the decision making because you know what to expect. It's not happening, you get out. Or you tighten your stop, or you're prepared. Okay? So the whole point of these things, again, is they serve as a starting point. Now, let's take a look at a chart. All right? Let me pull up an actual chart here of a double top, okay, a real one. And we're going to talk about it because we're going to talk about, what it means as far as trend reversal. Now, what I have here is Bitcoin, okay? And here's what I want to show you about Bitcoin. Forget that range that we're in. I want to show you this right here, okay? Right there. This is a double top. Okay, can you guys see that? Well, let me see how my channel's doing here. Okay, cool. Now, as we can see, it didn't go much higher than here. It lingered a bit, but it started to produce, like it tried to sell off quickly here, right? This was tricky, but eventually it started to follow through. Now, as you can see, this served as a reference point. But not only that, as you can see, I have a resistance zone that goes way back here. Okay, way back. The point is, you had a point of reference. You should have been prepared for a selling reaction up here. So how does this help you? Well, if you're someone that's new or you're looking to buy Bitcoin, for example, and this thing looks like it's trying to break out, you say, well, I have this high over here. I should be cautious here. This is likely to give me a double top. So let's see if it does. Now, the other thing remember, there are variations of this. If this thing broke out slightly and went slightly higher, a lot of times you'll have all these breakout traders jump in. Typically a breakout trader is a novice trader because it's a very simple strategy. It makes sense, it's logical. So they all jump in at that breakout, but meanwhile the breakout doesn't follow through. That's a failed high. That is also a double top, although it's slightly higher. Okay? Same with the bottoms. We're going to talk about that. All right, so now, Johan, good question. The wicks definitely help. But that's a candlestick. That's an issue of candlestick analysis, and that's where confirmation comes in. That's how we use candlesticks to help us confirm. So the point of understanding the chart pattern is the chart pattern gives you a point of reference. Obviously, you need a point in place first before you can get the second point, right? You even have this little mini double top over here, which is, I call it mini because it's pretty close to each other, okay? Right, Andrew likes those breakout trades and I don't. But I like a certain type of breakout trade. He just takes anyone. Anyway, so the point is, what these chart pattern, this chart pattern, all of them give you, and by the way, I'm giving you 4 patterns that basically make up all the other patterns, and these 4 are the only ones you really need to be very familiar with to put them to work in your trading. Okay, you don't need to be familiar with all these crazy fancy names and all these cup and handles and all that other stuff. You don't need to know that. You just need to know 4 configurations. So, and this is one of them, right? The double top. So again, it gives you a point of reference. It allows you to be prepared for a change. We don't know if it's going to break out or not, but you're prepared if you get the signal that it's not going to break out and turn. That could be a selling opportunity. That can be an opportunity to lock in profit. The thing is, you're prepared. Okay? Now, so that's the double top. Now here's the thing. Let me go back to my slides here for a moment. All right? Let me put my slides up because I have a question for you. Let's see, just a quick pop quiz to make sure you guys are listening. So, after everything I just said about the double top, which answer would you say it is? Okay, so the double top is A, a confirmed trend reversal, B, a point of reference, C, a level to buy for a breakout. All right, you guys are listening. You guys are good, man. I can't fool you guys. I tried to throw like a trick question in there. I'm going to have to make these tougher next time. Okay, cool. So it's a point of reference, okay? A lot of people want to react to them. They just jump in as soon as it shows up. No. Also, keep in mind, these are daily candles, which means, first of all, you have to wait for the candle to close, which takes a whole day. All right, I emphasize that. Okay, cool. All right, so that's the double top. Again, if you have any questions about this stuff as I'm going through it, some of it may seem basic or rudimentary, very basic, but the thing is that you need to understand these from a very basic and simple level. More complexity does not make a better trader. In order to make decisions quickly, especially on smaller time frames, information needs to be as simple as possible. Otherwise, you'll be too indecisive and you're going to hesitate. In this game, especially when you have size, you cannot afford to hesitate. All right, so the double bottom. The double bottom is a similar situation to the double top. Okay, obviously it needs to make a low, right? And it pops up off that low. Many traders jump in off that first bounce, thinking, okay, I just bought the bottom, or I'm getting an opportunity to buy a pullback. And this is very common, like in the stock market. I've been talking about this with the NASDAQ 100, which we're going to take a look at. Buying that initial bounce at these levels is a bad idea. Okay, so is the double top pattern the same as a fifth Elliott wave failed? Yes. Bogus, you can say that. It's basically a wave 5 because it attempted to push that high. But of course you have to have 4 of the waves in place to consider it a wave 5. And then it goes slightly higher and fails. So yeah, you can call that a wave 5 attempt. There's a name for that. But yeah, it's the same idea. These, by the way, Elliott wave basically took these chart patterns and kind of evolved them further. Right? I mean, that's Elliott wave. You're looking at motive waves. You're looking at corrective waves. And instead of looking at just one pattern, it's more of a complex series of patterns, right? With a little bit more meaning. I've done Elliott wave webinars, by the way. For those of you that are new, you can go to my Greenbridge website. You could sign up as a free member, go to the webinar library, and I believe you can see one of those Elliott wave webinars. But if you're a member, of course, you'll see it. So. That's right, DJ. No one likes me on TradingView. Okay? No one I got a couple of people. You like me. Irina likes me. She put some nice comments. A few people like me, but the crowd doesn't like me. And that's okay. Cool, JJ. The herd doesn't like me. And that's fine. I'm okay with that. So, because I'm realistic. Now, and you know what? It takes maturity and time to realize that, realistic is the way to go in these things. Everyone wants the dream that you see. You go to a day trader website and they say, you're going to make $5,000 a day? Just pay me $5,000 first. and I'll teach you how to make $5,000 a day. It may take you a little time, maybe a month or two or something, but remember, there's a risk that you can lose all your money. But anyway, just give me the $5,000 and I'm going to teach you. And you're going to make $10,000 a day and spend more time with your family, right? All that stuff that they push on those websites, it's a dream. After a time, you realize I spent all this money, I'm not making money. You realize I need a more realistic way. And we've all been through this learning curve, okay? So, right, because in JJ, it's important to really be very familiar with the basics, because the basics are what will allow you to make those decisions with confidence, because you're going to understand why you're doing what you're doing and what you're going after in the market, okay? It's not just a pattern on a chart. There's a lot more meaning to it. There's a process. There's a reason why this double bottom is a double bottom, okay? So let's talk about this double bottom. So when the market retests that low again, okay, there are two things that happen here. Who can tell me what two things happen in terms of the herd, other traders, when the market retests the low? What two things happen here? Okay, shorts, because it breaks out slightly, right? It breaks a little bit lower. So you have people going short. They're saying, oh, this thing's bearish, right? People do this in Bitcoin all the time. I don't know why. Anyway, so you have shorts. What else? What else do you have going on here? Something else goes on here too. Okay, besides shorts, what else goes on here? Who can tell me? Longs, okay, Erzos, accumulation by big players, okay. But what about, now I'm talking about the herd though. The herd, what does the average trader do here? There's two things they do. Short is one of them, and then there's another answer. What's the other answer? There's a second thing that people do. Bail out. Simeon, got it? That's right, DJ. They bang out of their position, or they get margined out, okay? Either one. But that's typically what happens here. Now, who's waiting here to collect all that order flow? The big players, right? Of course, when a large player steps in, we don't know that, right? But that's what we're looking for. We're looking for, whether it's a large player, whether it's a large group of traders that are just waiting, or they're getting absorbed. All these sell orders get absorbed by buyers that were sitting there. There's just been a glut of buy orders that you don't see. The selling gets absorbed, and now you have all these shorts. But then there's no one left to sell. So what do you think happens? Well, all those shorts now become buyers because they have to get out, right? So now you have all those buyers plus new buyers jumping in because they say, oh, it's a bottom. I'm going to buy it too. And you have all that buying pressure that comes in. And that's where you get the short squeeze. Right. This is a very common pattern. All right. You hear about this all the time, but this is why it works. All right. And this is a great pattern. We love these patterns. Now, this pattern in particular, what makes these patterns very valuable is not the pattern in and of itself. It's the context of the pattern or where it appears. All right. So let's take a look at the double bottom and let's look at a real chart example. All right. And again, so if you guys have any questions, please type them in the channel. If you're watching on YouTube, let me know. So let's take a look at Workhorse. Workhorse is a recent stock that we shared as the trade of the week over on our podcast. We sent this out on Monday, a couple of Mondays ago, I think, or the more recent Monday. And let's take a look here at Workhorse, okay? Now, so example of a double bottom. Can you guys see it? You guys could see the trade on the chart. That's the trade information that I emailed out to everyone, okay? Can anyone see the double bottom? Oh, you got it, Simeon? Great, great. We get a bounce in the market. This thing is in position to go, okay? It's in position. Whether it goes or not, I don't know, but it's in position, all right? That's what I love about it. So yeah, it pulled back a bit, okay? It pulled back, but, okay, look. What is this? What is this? We had this bounce, right? On July 10th, bounced up a bit, had some noise in between, and then it retested that low. Now it went slightly lower, sucks in the shorts. People bang out of their shares. Oh, this thing sucks. It makes new lower lows. This thing is garbage. But why would this thing be garbage? Forget what we know now. Okay, let's just say we only had this information right here. Okay, because this is what the double bottom looks at the time. We don't know about this yet. Okay, we only know about this. And when we see it testing the area, What makes, yes, Pal, that's what I was, man, Pal's a step ahead. You know what, Pal, you should do this webinar because I'm tired of doing these webinars. You should just take over the camera and do the webinar. Now, you guys got it, okay? The structure. What's important is not just this double bottom. What's important, here, I'm going to draw a box around it here, is this. This is the context. That is why that double bottom is so important and why it catches our attention. And we're like, oh, outside bar, okay? And we had sent out, when did we send this thing out? I forget the exact date that we sent out this trade. But the point was, the trade was at 1585. It was a limit order to buy, okay? A limit order because at the time, Workhorse was at like 16 and a half. Was it it was a week ago today. Okay, it was a week ago on Monday, right, the most recent Monday. This thing was higher. It was in the 16s. And in fact, I had a question in the chat room from Michael. And he asked me, should we adjust Workhorse for because it's not going to 1585? And I said, no, you know what? Don't adjust. Leave that limit order in there because this thing is noisy and it's likely to fill that limit order below the market. And that's what it did because the NASDAQ pulled back, pulled back a couple of 100 points there, a little bit longer, and that was enough to get this thing going, right? That was enough to get this thing going. And in fact, that was back here. That was here, not back here. That was after the outside bar, okay? Right, it was like maybe a day or two after. But the outside bar, once that thing showed up, I think this was the Monday when we sent out that Monday night. I think it was that day, all right? And you can't chase these things. So the double bottom was in place. We didn't buy the low of the double bottom, and that's another important point. When you have a double bottom or double top, you can't expect to get the best price in that formation. That price is just a point of reference, and you're looking for confirmation there. We didn't get a nice pin bar at the best price here. We got an outside bar, and this thing was like pushed up nicely at this point. By the way, if you're watching on YouTube, give me a like or something, or make sure you register for the channel. I'm watching like 2 channels here. I want to make sure, I'm watching you guys on YouTube. So again, if you have any questions, please put it on YouTube as well. Okay, if you're watching this after the fact, well, you can put your question in there and hopefully I'll get to it. But okay, so we didn't get the best price here, but we saw the outside bar. And again, I know the behavior of Workhorse. I know how nutty this stock can be. The NASDAQ pulled back and it filled. And now here we are, with Friday's close, nice bullish pin bar off the double bottom area. This is now in position to run if we break the high of that pin bar. Okay, so we got the confirmation. We took, taking the trade on the limit order is a little bit of a trickier type of game. I'm not going to talk about all that. But the point is, that trade was based on the double bottom inside the consolidation. And it was in place after, the double bottom was in place after we put the trade out. Okay, so which means you're not going to get the best price. So I got a question from Pal. Do you also take into account fib levels in this area? Well, it's a good question, Pal. The answer is yes, I do look at them. I look at both. So that's when I talk about proportional support or resistance levels, that's what I'm referring to. Historical would be an actual touch of the level. That's why I'll draw like a line like this. Proportional, I'll put like a dotted line. And that's because it's based on a measurement rather than an actual price. Okay? So yes, I do look at those because I use that as more confirmation. But I mean, the real key to confirmation is the candle, not just the level. The level provides the location, the probability around the location, right? And that's why, again, these formations are so important to understand because this is in a great location. We got the formation in a great location. Some may argue that this is a double top, right? Say, oh, look, why would you go long that, Greenbridge? You guys just bought into something that's weak. You got a double top. Well, the thing is, what's going to carry more weight? We talked about the broader structure, the context. That double top, unless you're day trading, you're nuts if you short that because you're asking for trouble. This thing is strong. This is likely to be a wave 4 and at least attempt at a wave 5. That's the perspective you need to have. That's what's going to give you the confidence and reduce the confusion when you're looking at these situations. Okay, so good question, Pal. Bogus, is space important between the 2 bottoms and tops? Good question, Bogus. Good question. Well, on the daily chart, yeah, more space is good to have because it means that there's more volume involved. The more time, the better. The greater the probability, in my opinion, the greater the reliability. We're going to talk about time frame or magnitude here in a moment, but I do like more space. Now, it can't be ridiculous though. Like you can't have 3 months in between, although it's possible. I like to see at least 3 or 4 days on a daily chart. That's ideal. You don't always get it perfect like that, but it's nice to see something like that because it's symmetrical, okay? So that's what I like to see. It looks like a nice V shape or, an inverted V shape if I drew that on here. Does that make sense to you guys? What is that TI do you use to confirm the trend changes besides patterns? TI, Lewis? What does TI mean? Technique? What TI do you use? Oh, I'm sorry. Thanks, Simeon. It's what happens when you have all these things going on here. Okay. Levels is the answer. So trend is a very vague thing, right? This trend is bullish until we get some changes here, and it needs to take out supports, right? Now, if we take out this support here of this low that it made, a 13.25, for example, this area, and we close decisively below, that's the first sign of a change of trend. It's the first sign. Now, I'm not going to sit there and call it bearish because it can still fake out and give us just a slightly, another higher low somewhere, slightly lower. But the first sign of the trend change is the break of support, the key support, and then followed by a lower high, okay, which we're going to talk about higher lows and lower highs here momentarily. Johan, is volume taken into consideration for confirmation at all? Great question. No, we don't really look at volume. I like to use volume for day trading type strategies, if anything, and that's really more when it comes to, it's relative to order flow. Otherwise, we don't really look at volume on these things. The reason, it's not that volume is bad, but the problem, especially with Forex, volume is useless. Volume is not as accurate or as clear as it used to be. There's all kinds of ways that they can hide orders and blah, 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 and this and that. So you don't really know if that volume is really that accurate anyway, okay? So it doesn't really seem to make a difference. And Simeon, okay, MFI, RSI, well, I did a webinar actually on oscillators where I covered a couple of different ones, and we don't use them, okay? Not for this. We're only using chart patterns, we're using locations, we're using candlesticks, and we're using proportional measurements like Fibonacci levels and things like that. Basically support and resistance, okay? But it's really the chart patterns, the location, and the confirmation, which comes in the form of candlesticks. Right, so those are the swing trading key elements. We don't waste our time with, see the problem with oscillators, and I did a whole webinar about this, the problem with oscillators is they're backward looking. So yeah, they're great if you're in a trend, but if you're not in a trend, all they're going to do is throw you off because you're looking at old information. We need to anticipate. We need to know what's ahead. So the way we're able to measure those probabilities is by projecting or looking forward. Oscillators look backward. All right, so it's not that, they have a use, but just not for our strategy. Now, let's take a look here at the next slide. All right, so that's workhorse, and that's a nice example of a double bottom. So let's talk about the lower high because you just asked me about trend change, okay? So the first thing that needs to happen in a trend change, the first criteria that needs to be is a major support, not just any support, a key support needs to be cleared, decisively broken, meaning price goes below it and closes below it on the low. If price goes to that low, breaks lower, and then gives us a pin bar, that's not a decisive close. And we have that situation right now in the NASDAQ. But so let's talk about the lower high, right? So the lower high, this could start out, right? This could eventually turn into a double top, or this can follow a double top. So let's say this was your second top, and you get your initial push lower, okay? Now, again, you get all the people trying to buy that buying opportunity, that first buying opportunity, and this is where usually you get the uninformed longs. You get the people on their phone apps, oh, I'm going to buy this stock cheaper now because here's the pullback. But they don't realize where on the roadmap they're buying this thing. And it goes up to a point, but once it's broken, once it breaks its major support and you get these lower highs, the party's over, okay? We don't see, oh, you don't see the chart? Okay, oh, thanks for letting me know that, because it says that I'm showing the chart. Hold on, let me do this again here. Thanks for letting me know that, guys. Oh, the graphic. Yeah, okay, right. No, I'm looking at the blueprint right now. Hold on. Hold on. No, I'm showing the graphic. Right, I don't have the chart up yet. I don't have the chart up. Okay. Oh, you guys throwing me off here. Come on, guys. Okay, anyway. So, it's okay. It's cool. So, again, the lower high is the place where the selling activity comes in harder, right? And these points can be anticipated. These points, you can use Fibonacci, you can use historical levels to anticipate where this turn can happen, okay? And once you get the confirmation in that area, that's it. So that's what tells you, okay, I should be short, this is an aggressive short, okay? If you're going to take a short, an aggressive short, it should either be a failed high or a lower high or a double top. It should be one of those, and we'll talk about those. But there's a difference between a formation like this and a trend change. Now, all right, this could get confusing. You can have a lower high as part of a broader bullish trend, but it's really just part of a retrace, right? A smaller retrace. It doesn't necessarily mean that the broader trend has changed. That's what I was talking about earlier. You have to have trend defined on a certain magnitude. You have to say, okay, I'm looking at, like, for example, we look at daily charts, and like the trend on the NASDAQ, for example, is bullish. There's no question it's bullish. Even though we're getting bearish formations right now, doesn't mean the trend is changing. The trend is still bullish. We're just getting bearish momentum. And that's really what the sign of a lower high is. It's bearish momentum taking hold. Now, the lower high, the typical thing is when you get a lower high, what follows a lower high? I say this all the time. Who knows? I'm sure DJ and Ankit know. Lower lows, right? Ankit got that answer right away. Lower low, right? So wherever you get a lower high, what is likely to follow is a lower low. Now, so this is where, the context can help you determine that probability further. If you're in a strong market, like the NASDAQ, for example, and you get that lower high, and you're testing the low, and you say, okay, well, lower high, lower low, but you're on the NASDAQ though, okay? What is more likely to happen? A lower low or what? Who can tell me? Failed low, right, pal? So what's the difference there? Why did you say failed low? Why? Why did you say that? You're right. Because the general bullish trend, right. So if you were in a general bearish trend, then the lower low would be more reasonable, not the failed low. Do you see how that works? Because there are markets out there, like the dollar franc, like the US dollar, like, oil was for a little while there, where the trend was, the trend and momentum was bearish, and those lower lows were more within reason, okay? And that's why, so what's the opposite of that? The opposite is, not to be buying the double bottom there, okay? I think that what I struggle with is the break point when the trend is no longer considered bullish. Okay, so again, that's really a proportional thing, and we're going to talk about that. Let's get onto a chart here. Okay, enough of these graphics. Let's take a look at a chart, and let me show you what I'm talking about. So let's find a lower high here. Hold on, I have it on my next. So the Qs. Okay, now the Qs, we know the trend is bullish. So what I'm going to show you on the Qs is what would allow us to say that the trend is bearish. So what I'm going to use is the NSX, because that's the one I like to use. That's the CFD of the NASDAQ 100, as you guys know. Okay, hold on here. Okay. Now, so while we have this up here, let's identify this real quick together, right? So I brought this up as a lower high, not because of this situation though, okay? But let's talk about this. we have one here, and this is why I'm bringing up the NASDAQ, because it's tricky, right? This is the pattern that I just showed you the blueprint of. See this here? Let me make this bigger so you guys can really see it. The lower high, okay? Now, many people were probably saying this market's a short, blah, 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 this and that, whatever. The market's turned bearish now, blah, blah, blah. But there's nothing bearish about this. This is just a change in momentum, potential change in momentum. Now, with that aside, what did we get up here? What is this up here, everyone? What did we get the other day? Double top. Double top. That's why Andrew sent out like 10 trades. Short the Qs, short the NSX, short this, short that, sell a call, short the DAX, right? We're shorting everything. But double top, it's aggressive. Is this trend bearish? Let's see. Is this trend bearish? This trend isn't bearish. What would make this trend bearish? Well, we got the double top, which means there's now a change that's taking place, okay? I wrote in a recent analysis that in order to confirm the double top, we need to clear this 10,300 level. Why 10,300? Because we had a level there previously, okay? Now, it tried, but is this a break? Is this a break? Can we confirm that double top? Is this a break? No, it's not a break. It's a fake, right? And that's why we call it an aggressive short, because this is not a bearish trend, although we still took the short, right? Because we were just looking for the bearish momentum temporarily. Now, because we're getting this is what I was telling you before. This thing should not give us a pin bar. Now, who knows? Maybe tomorrow we'll gap lower and we'll take out these lows and then we'll start pushing lower. But to answer your question, pal, you said, well, what's the difference between the trend change? The trend change on this time frame, it takes a long time to play out. It can take weeks. Why? We need to clear a major support. And the major support is here at 91.50. If price closes below 91.50, chances are the broader trend is changing. Okay? That's a long ways from where we are. Some people say, oh no, the trend changed a lot sooner than that. Why are you guys, saying it's bearish now? Because there's a probability still favors bullishness between this high and that level. Okay? A bullish reversal is more probable in that entire range. That's a very large range. All right? And it takes a lot of patience to work with something like that. But we would not be bearish or have a bearish outlook on this thing until it closes below. Does it mean we will not take shorts? No, we'll take shorts in the NASDAQ. We have no problem. But we know that it's not a broader situation, and we'll be prepared with our long strategies at these inflection points. That's the difference. Okay? Yeah, right. But that's the difference. So so the reason why I brought this chart up for the lower high is not just because we had one in place, which didn't go anywhere. All right, these lower highs, we didn't get the lower low, right? Not initially anyway. And what did I tell you guys before? You take the short and you get this bullish inside bar. That told you right there you were wrong. Okay. In fact, I think we took a short here and we got out of it. Wrong. The market's saying you're wrong. All right, we gave it a try. The market said, hey, maybe. And then the market says, you're wrong. We don't go on our own opinions. We don't go on our feelings. We go on what the market tells us. Now, situation here. So why did I bring this up again? NASDAQ. Why did I bring up the NASDAQ as far as a lower high? There's no lower high over here, right? Well, because this is a good example of to anticipate one. Now, we have the double top in place. What is likely to follow is a lower high. Okay, because we have this double top and there's a better chance. It doesn't mean it will happen, but there's a better chance. Now, if we get that lower high over here, okay, let me draw a box there. If we get that lower high right here, okay, in the next week or two, market pops up. When the market pops up, by the way, if it pops up, because it looks like that's what it's poised to do. So let's say it pops up. You turn on the news. What are they saying? Oh, hey, the market's going to get a new high. Oh, the NASDAQ's up 1,000. The NASDAQ's up 300 points today, and a great day for stocks, and blah, blah, blah. Okay? But then it stops here, and you get like a bearish pin bar here. what pattern do we have if we get that? If that unfolds and we get a bearish pin bar here, what pattern do we have? Sell at the rectangle, the lower high. Johan, you got it. DJ, you got it. Head and shoulder pattern. Okay? Shoulder, head. The head doesn't always have to be dramatically higher. That would be an ideal head and shoulders pattern. It's just the basic idea. Remember, none of these things are exact, but you would have a right shoulder. And that goes back to my point earlier. These 4 configurations, I didn't go over the 4th one yet, but the double top, the double bottom, the lower high, and the higher low will give you the construction, the building blocks for the rest of these other patterns, like the head and shoulders. It's basically a double top or failed high followed by a lower high. So that inflection point, or that point where we can be prepared for a change, we know in advance. We know this today. Okay? Now, it's all about if, because people like to make predictions, and they'll say, oh, you know, the market's going to bounce, and then I say it's going to do this, and then I say it's going to do that. It doesn't matter what you say, or it doesn't matter what you think. All that matters is what the market does. This is the herd. They're driving their orders, and they're going to do whatever they're going to do. They're going to react to whatever information is out there that they're going to react to. Do not be one of them, because the herd is what provides our profits. Okay? That's how the market works. So you want to anticipate. You want to be ahead of them. And this is how we do it. So we say, okay, we have a point here in the future that we know is a likely reaction point. Do we get the reaction? We don't know. It's up to the market to provide evidence. If we do, we can then take a chance. It's an aggressive short, but we can take a risk. We can risk money and bet on a potential lower low. We can bet on it. Now, it's a lower likelihood because this market is still bullish, and the market's going to be bullish until we clear that 9100 area. So that means the probability of this really following through is limited. It can happen, but it's limited. So let me ask you guys, okay? If I know that we have a lower high in place, and I take a short, and I know that this trend is bullish, but I know that lower highs are likely to lead to lower lows, but the context of this trend is bullish, how do I adjust for that? What do I do? Who can tell me? What do I do? So I get short, what do I do? Hedge, that's a good answer, but no. No, hedge is not the answer I'm looking for. Lower your entry, 1%. Reduce your risk is 1, so smaller position size in case I'm wrong, right? Because there's a good chance I could be wrong. We're in a bullish trend, so I can compensate for that elevated risk. Okay, what else? What's the other thing that I can do? This might not be on the top of your mind. Tight stop is a good answer, okay? But the stop in this situation, you know, I don't want to be too tight. I want to give it enough room to let this thing play around. But you're close, though, Simeon. You're close. You're very close to the answer I'm looking for. Well, so more conservative targets is the answer. If I'm anticipating that we get a failed low because of the strength of the trend, okay, rather than a nice, clean, lower low, then I should be tighter with my targets. So I should be less optimistic, not more optimistic. This is why, you know, people that put like these Bitcoin shorts, for example, and they say, oh, Bitcoin, there's a short signal at 9,000 and it's going to go to 3,000 because I did a projection and that's what it says. That is a very overly optimistic target because the structure does not support that idea. The structure does not favor such an idea. Sure, Bitcoin can pull back. Sure, Bitcoin can test a support at 8,500 or 9,000, but it is more likely to give a failed low. So the smart thing to do, have more conservative targets. You adjust your targets. And if the reward risk doesn't make sense, meaning like, well, you know, the target would be here and the stop, it's a little less than 1-to-1, then you don't take the trade. You find something else with better reward risk, okay? And that's how we formulate these ideas. All right, so that's the lower high idea. All right, so again, and that starts again with people that they jump into this thing, they all think they're buying the new low, the buying opportunity, blah, 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 and then the market doesn't go to new highs. You have all these longs that are now stuck in the trade, and they all start banging it out. They all start all at the same time, okay? That's the herd. And the herd is what develops the mentality of the herd. the psychology of the herd, like I said before, the expression of order flow is what is responsible for the development of these patterns. Really, these patterns develop, they can appear randomly, especially in smaller time frames. So it's the context or the location is what gives them value for us. Okay, let's move on to the next slide. The high or low. Now, I'm running out of time, so I'm going to have to go through this quickly. But again, let me know if you guys have questions. You guys too in the YouTube channel. All right, so the high or low is the opposite of the low or high, right? We have the market comes off of some low, right? Bounces a bit, and then it pulls back. Now, just like the early longs, in these situations, you get early shorts. Because they say, oh, you know, this market's weak, this thing's going to zero, blah, blah, blah. So they're short anything that they can get. Now, if this high right here, okay, is higher, now listen to what I'm saying. If this high is higher than some other high, let's say the market pulled back a bit, right, gave us like a little peak over here, made a low, and then this market takes out that little minor peak. That's a change, okay? And that's very common too, like on smaller time frames. All this stuff is common on smaller time frames. You just have to adjust your thought process and your expectations when you deal with them on the smaller time frame. But when you break that, that's a sign of a change. That's when the higher low is more likely to develop, okay, rather than the lower low. So when you see that situation, again, these levels can be measured. These can be, you know, a 382. They can be a 618. You know, they can be measured. It could be a double bottom. There could be a structural low back here somewhere that can basically help you anticipate this, but that is what you're looking for. Now, once you get confirmation, no, I don't have the chart up yet, Lewis. I'm showing the what do you call it? The blueprint. What you can't see is the, you know what? I know why you guys are getting confused, because you can't see my pointer. That's why, because a stupid pointer. Here, now you see my pointer. I'm pointing to this chart. I'm pointing to things on this chart, and you guys can't see the pointer. That's why you guys think I'm on the chart. Sorry about that. I had to go through the whole webinar. I just realized it. Sorry about that, you guys. Okay. Right. So this is what I'm talking about. I just went through that whole thing about all this structure over here, and you guys can't see what I'm talking about. All right. So real quick again. So this high right here, okay, if this high is higher than a high that was made over here, let's say there was a high over here, okay, as you can see with my pointer, and this high takes that out. Now, this is more likely to happen, the high or low. Like I said, this can be measured from an inflection point, you know, a historical level back here. This can be a Fibonacci level, but that's what increases the likelihood where you can anticipate this when it's still here. So the shorts are jumping in here, not realizing that there's a higher probability of this happening. Does that make sense? So once you get the confirmation, just like I showed you on that workhorse chart, you're not going to get this bottom. You're not going to get this. You're going to get somewhere over here, okay? But that's all you want. You want to make sure others are stepping in before you, so your risk is nicely and reasonably measured, okay? And then the breakout traders are jumping in here. It's the breakout, it's the obvious trade, and we're selling here. We're locking in profits while all those new buyers are jumping in because you sell when you can, okay? So does that make sense? I'm sorry about the slide situation. I didn't realize that you guys couldn't see my pointer. So that's the blueprint. Does that make sense? Any questions about that? Because I want to jump into the chart here. Now I'm going to show you guys the chart. So let me pull this chart up and hold on. The chart that I want to show is Ethereum. Do you use a screener for your chart patterns? That's a good question, Johan. That's a good question. The answer is no. We do it. We don't use any kind of screener. Although you can, because that can help you at least go through thousands of them, you know, or scan thousands of charts, especially on smaller time frames. That's when a scan would really be, I think, most beneficial. And then you could use your discretion as far as, you know, does that pattern make sense or not? Because sometimes it pulls up these random patterns. But for our purpose, especially for the type of trade that we do, swing trade, we just look at daily charts. And, you know, it's not like we're following thousands of markets. So we can manage everything that we do manually. Now, so I want to talk about the higher low on this Ethereum chart. Now, Ethereum, this is crazy, right? We haven't seen this in a while. Ethereum's been garbage for a long time. And then this Would you guys buy it up here? But that's a dumb question. That's a dumb question for me to ask this crowd. Would you guys buy Ethereum up here? Right. Of course not. Because you guys know better. You guys know better. You guys have been following me too long. That's why. That's why you guys say no. Maybe at one time you would have said yes. But you guys know better. And now you get this bearish pin bar, which means it's poised to pull back. So great place to lock in profits. Not a good place to be buying now. This is where, people who don't know any better, who are uninformed, should I buy Ethereum now? No. Anyway, but the point of this slide, though, is the higher low. Now look at this. What do we have here? Let me highlight it here with a box. What do we have here? What is that? What is that, guys, girls? What is that? The higher low. Well, not necessarily a trend change. It's just it's a momentum change. Think of it, if you use the correct terminology, or I shouldn't say correct, but if you use effective terminology, it'll put you in the right mindset. If you say trend change, that may imply something too strong or too broad. Momentum change implies temporary. This is a very big psychological game, believe it or not. Your own psychology versus the market. So that's why terminology, when people think in absolutes, for example, it really can throw you off because there are no absolutes. Things change real fast. So I would like to think of that as a momentum change, right? So we got the higher low. So that's the same trade I took, but on the BCT chart. Right, and that's basically the idea, the higher low. Now, but what occurred? Why is this higher low? Look, we had some higher lows kind of going on back here, okay? Sort of, back here a little bit. Is there any particular reason why this one ran? No, this is random. It ran this time because whatever, there's news, there's a catalyst, whatever, but it began with the higher low. We don't know that it's going to do this. We don't know how far it's going to run. There's no way to know. All the breakout traders jump in. A lot of times you get these vertical moves like this because half of this population in this consolidation are short. They're short. So when this occurs, they're all getting squeezed, right? And they have to jump out of these positions. That's what leads to such a powerful move. Okay, now, we got the higher low here. Now, here's what I want to point out about the higher low. How long did this thing take to develop? Was it just like, oh, 1, 2 candles? Okay, great, I just jump in. No. This began first. First, you had to have the high. Now, what did I say about that starting point before? I said that if you had some kind of previous resistance level, that's a minor one. You have another one over here. This is not the best example because this is a range-bound market, but we can still use this as an example. Okay, right, Simeon. So this high over here, this high, took out these highs, closed nicely above. This is a sign of change. Uh-oh, a weak market shouldn't have done this. That means something, okay? So that at that point, which is what, July 7th? At that point, you could have come to the conclusion that this is likely to make a higher low, or at least give me another double bottom or failed low situation because it should not have taken out these highs if it was going to stay, if bearish momentum was going to stay in control. Does that make sense? So now you have the power to anticipate, and you could say, okay, well, let me wait for that higher low. We don't know if this was going to be the higher low over here. You don't know if it's going to be over here. All you can go by are the candlestick confirmations. And look, you got this pin bar here, which didn't really work very well. If your stop was too tight, you could have been stopped out. But it was followed by another inside bar formation. Again, I'm not here to talk about candles, but that's what helps us say, okay, even if you got stopped out, maybe you got in too early. Okay, this is what gets you back in, not short. You shouldn't be shorting this. Do you see how that works? Do you guys, if I put this up like this, how many, now be honest, if I put that up like that, how many guys or girls, how many people would have thought that that might have been a short if you didn't know, what was coming? Be honest. Okay, would you guys have thought this is a short? Or would you have said, well, this market's in a range, so I probably wouldn't be shorting it, especially since it's in the middle of the range. I'd rather look for a long somewhere near the low of the range, just like we've been doing in Bitcoin. Okay, but instead, so you got the higher low, and there you go. So what the higher low does is it gives you a point that you can anticipate in the future where you can look for a change, a confirmation, and it opens up the opportunity to participate in moves like this. You don't know if you're going to get this thing could have given us a failed high, but this is why we use targets. Okay. Now again, I bring up Ethereum because this is a very unusual move for Ethereum, and I like the fact that they're breaking and outperforming Bitcoin. I do like that because that means money is pouring into these markets, and there's going to be more opportunity moving forward once these things start giving us some higher lows, right? That's what we'd be looking for in something like this going forward, is a higher low, and most likely somewhere the historical spot would be this old resistance, but we're more likely to get a higher low based on a proportional level. That's what we'd be looking for first anyway. Okay. Well, okay, good, Simeon. So consolidate, that's that. Now I was a little ahead of you there. I would be looking for that inflection point based on a proportional level, which, basically what you do is you'd measure, you look at the whole move. Okay, there's two ways to go about this. You can look at the minor, which would you just measure this move, and it'd be somewhere around here. Or you could measure the entire move from this low to this high, and it'd probably be, somewhere inside of this consolidation, probably somewhere or maybe just above it, which makes sense historically as well. Okay, this old resistance around 250, that would be an ideal spot. Ideal, because people will be banging it out thinking it's a short again. Okay, does that make sense? And that can take a month to play out, or a few weeks. So you have to be patient with this time frame. Patience pays. As you saw, we were in that Bitcoin trade for a month before it got even to its second target there. Okay, so yeah, and it's likely to happen. Maybe it'll give us a higher level, but either way, we're prepared. So here's one more concept I want to run through real quick, and then we'll wrap this up because I tend to go over on these things. But what I want to point out is this: time frames and the weight relationship. People will send me like a 30-minute chart or a 5-minute chart, and they'll show a pattern on it, like a double bottom or higher low or something. And they'll say, well, what do you think of this? It's a long, right? But then, you look in the daily chart and it's in a really lousy location. Okay? The concept that I want you to take away is, especially if you're new, is the larger the time frame, the higher the probability, or I like to say the greater the weight. So if you see a double bottom on a 1-minute chart, how does that compare to a double bottom in terms of probability? How does that compare to a double bottom on an hourly chart? Would you say that the 1-minute chart double bottom is more reliable or less reliable? Okay, pal, you got it. Hourly, more weight, which means the hourly has a greater probability of holding that support. That would be more valuable for a day trade, again, for the hourly chart. But as far as a swing trade goes, if we're looking at an hourly chart and we see a higher low on that hourly chart, but on our daily chart, we see a bearish pin bar, which one do you think carries more weight? Should I go by the higher low on the hourly, or should I go by the bearish pin bar on the daily? The daily, because that bearish pin bar carries more weight. So that's what I mean by higher probability. The bearish pin bar would be much more reliable compared to the double bottom on the hourly chart. It's so important to understand that concept. It took me a very long time for that to be absorbed. I'm very stubborn, and I have a hard head. So what am I going to do? It took me many years to really comprehend what that means. Okay, so what this goes back to also is these patterns are random, and the smaller time frame, the more random they will be. The larger the time frame, the more reliable they will be. All right, so and Ankit, that's good. If that's for your strategy, I always pick on people with these 5-minute charts and stuff, but if you're a day trader, they're perfectly appropriate. All right, but if you're not a day trader, that's where the confusion comes in, and you really do yourself a favor if you stay away from the smaller time frames and focus on the larger time frames if that's your goal. Okay, you're trying to capture a broader move. You want to capture a 1,000-point move in Bitcoin. You're not going to do that on a 5-minute chart, not the way it's moving today. All right, so anyway, so I wanted to leave you with that. Now, one more thing. So I'm going to go into the Q&A now. I know I answered a lot of your questions as we went along here, but I want to do the Q&A to wrap up any other questions I may not have gotten. By the way, if you're new to Greenbridge Investing, make sure you go to our website, greenbridgeinvesting.com. In fact, here's our website right here. I'm going to show you real quick. And if you go and if you want to try us out, you can get 50% off your first month if you just put the coupon code TB Radio. But it's tricky to put this in because of the way this thing works. You have to go to our pricing, okay? And you have to go to our active investor, and you go to join now, right? And you go here to the bottom, and here's the coupon box. Okay, when you're a free member, it doesn't work out like this. So if you're not a member at all, you can do it that way. Otherwise, you have to send an email to Andrew and he'll do it. But I just wanted to point out where the coupon box was. Anyway, go to our website, greenbridgeinvesting.com. This is it, and you can learn about more about what we do, how we do it. We have our knowledge base, we have our pricing. You could join our free chat room. I'm looking to improve those, by the way. And we have a lot of stuff in there. We have a webinar library where this webinar will go, where I cover lots of different topics, and there's a lot of information in there. Okay, so just want to point a few of those things out. So let's go over these questions. Oh, and by the way, see this table I put here? While you guys are typing in your questions. This is our portfolio performance. Now I want to point a couple of things out. Swing trading and portfolio management are two separate and distinct strategies. So portfolio is more like investing. This is like, you're not day trading this. We're taking positions and holding on to them for months, okay? You're not watching every tick. So our year-to-date profit is 18.3%, or 18.3%. Now some people may say, that's it? I'm up 200% in NVIDIA, so you guys suck. But you have to understand something. Our goal is not to hit home runs. Our goal is to conserve capital and deploy capital in a very carefully risk-managed way. Now, if you notice, right, since we've done this, we started out with $50,000 on April 1st of 2018. And as you can see, our capital position has increased by $20,000 since then. Now, again, that's 30%, right? Now we have 43,000 whatever worth of stock, and then this is our capital position. That capital is for further deployment, for new opportunities. And we've been rotating in and out. So yeah, you can say, well, everyone made money since 2016. We've been in a bull market. Sure, but this will really shine when the market turns and all that opportunity dries up, because we focus on risk and we focus on careful not only the risk management, but capital preservation. So we don't have all of our money in at the market at the same time. We keep a position outside of the market of capital available to be deployed for new opportunities while we're rotating out of the opportunities we're in. So that's just an important thing to understand when you look at this. Okay? Okay, so that's where we are with that. So questions, people, give me some questions. What kind of questions do we got here? Pow, in a bear market, how do you swing trade stocks as well? Good question. So in a bear market, we will most likely, for one, we would have to look for weak stocks that have a good reason to sell off. But more likely what we would do in a bear market, for one, you have to define what you mean by bear market, because you can have a healthy pullback. Hey, Michael. Well, yeah, we're in the chat room. But yeah, and I'm just wrapping it up. But in a bear market, a broad multi-year bear market, that's different than a healthy retrace. Now, a lot of people are going to call a 3-month retrace a bear market. You're going to see a lot of that when we get a healthy retrace. In that type of short-term retrace, we will not short stocks. What we will do is we will short indices. So we'll go after the IWM. We'll go after the Qs. We'll go after the S&P. We'll short calls in those indices, because if the market gets wild on us, we have a lot of flexibility to get out of those positions and not take a big loss. Okay? People say, short a call, that's crazy. That's your unlimited risk. Do you think the S&P is going to run 50 points overnight? It's not. So we have flexibility to get out and take a smaller loss. If we're wrong, we can always hedge that short call as well. But the point is, that's how we would manage a bearish momentum situation. Now, a bear market, a full-fledged bear market, meaning the NASDAQ and the S&P have taken out their key supports and the market's going to go lower for a decent amount of time, we would look for relatively weak stocks. But it's hard to short stocks And you really have to be sure that the bear market is confirmed. Otherwise, you're shorting into a buying opportunity. So that's a very good question and a very tricky one. Okay, so the easy answer, again, is go after instruments that give you more flexibility, like the ETF, the index ETFs. Simeon, how do you determine the 3 targets? Those are a combination of proportional levels, projections, and previous price, like historical levels. So for example, something on Bitcoin, we know that there's a resistance between 95.64 and 10.168. So you better believe we're going to put targets in there, right? Because we know selling is likely to step in, and we want to get out as buyers are continuing to buy. That's why we exited our second target overnight at 10.150. Or whatever that target was, okay? We have one more target at 10,600 and we will put an aggressive one further out, because if we get that bigger run, hey, we still have a piece of the action, right? And that's why we'll put some of those third targets we put out, we know that they're much less likely to be reached, but if they reach, that's a home run, okay? We're really happy getting out at the second target, okay? Okay, hey, pal, no problem. Great questions, and thanks. And by the way, this webinar will be in the webinar library for those of you that want to see it after the fact. Plus, if you registered for this, you will get an automatic email with the link to the webinar as well, so you can watch it afterwards anyway. Okay, Johan, chart pattern question. How do you manage your trades based on, say, a double bottom? What happens when price moves to 60% of your target within 2 to 3 days? Do you stay in and wait for it? I find myself in this situation very often. Okay, so price moves, basically price is running away without you. Okay, so let me pull up an example of that, because what that brings to mind is Workhorse. Okay, let's take a look at Workhorse. Can I get Workhorse on here? Let me see. Hold on. Let me get Workhorse. Just give me a second. Hold on. Workhorse, I could have just typed it in, but I'm lazy. Workhorse, okay, hold on, let me just get Workhorse up here. All right, I think oh, there it is. Okay, so you said off of the double bottom, stock moved 60% on you. So the way we handle that, okay, wait in, I'm not sure what your question is. When price moves 6% of your target. Oh, so basically you're asking, should you lock in profits earlier before it reaches a target? Okay, that's a very good question. All right, in fact, you know what? Forget Workhorse. I'm going to pull up the euro for that example. Or, actually, no, you know what a better example? The pound, the British pound. We trade Forex and CFDs, by the way. We had great trades in gold recently, and the euro, and the pound. But let's take a look at the pound. Right? So it gets within your target nearby, and Forex is notorious for doing stuff like this. Now, so it's like near your target. We got into this pound, what was it, at 1275 or something like that? 1270 was the entry, and that was a little while back. I think that was off of this high right here, 2563. I said 12. I meant 25. Right? It's 2570 area. And pretty quickly, in one candle, it almost went to our first target. In fact, it missed our first target the next day by a fraction of a pip. Okay? So when you're in those type of situations, Johan, it doesn't hurt to lock in profit, but the key to that is you have to be watching it. Okay? If you're not watching it, then you just, then you have to decide if you want to just get out earlier and then forfeit the potential of this. Okay, but if you're watching it and it starts to retreat off of that level, it's giving you like a pin bar or something, that's your reason to unload or to lock in something. Okay, lock in something. Getting out, the mistake you don't want to make is if it doesn't give you something, it gives you a nice solid candle, you let it run. Okay, but if it gives you hesitation and it was like close, it doesn't hurt to lock something in. Okay, we do wait for the candle closes to make decisions. We usually don't do it intra-candle, not usually. Okay, unless it breaks a level, based on a previous closed candle. Now, another example I want to bring up is the euro. Okay, I don't know if I answered your question very clearly there, but here's why I bring up the euro. Because we were long the euro as well. Okay, we're still long the pound. We're waiting for our third target in the 28s. Now, with the euro, we made a mistake. Well, it wasn't really a mistake. We made a choice. We made a decision on the euro. And we saw that the euro went to our first target. Okay, I'm sorry, I think our second target, which was here. And then they gave us this pin bar. See that? See that pin bar? And we sent out an order to our members saying, we're getting out of this thing. We're taking our profit and we're getting out because we didn't like the potential failed high situation. This is what it looked like at the time. Failed high situation. We don't like it. And the next day, it took out the low. Triggered that pin bar. All right? Which is actually a short signal. So we exited on that pin bar. And we closed this thing at 14.09. Well, this market went to, what is this here? 16.58. So we left 200 pips on the table. Were we sad about that? Was this a mistake? No, we had to make a decision. We got out of this trade green. We wanted to keep the money because we know how what's the word I'm looking for? Unreliable Forex can be with follow through. We know how erratic it can be. You don't know that a move like this is coming. Now, we knew that the breakout was in play, but we saw the potential of the failed high. We didn't want this trade to turn red. So we exited the entire position green. So we had two targets reached and we exited our third one for a profit. But we missed our third profit target. Is that a bad thing? It's still green. So that's pretty much, now, so Simeon, that's not a bad idea. You could do a trailing stop, but the thing is you have to trail manually. Auto trailing stops are a bad idea because usually they stop you anyway at a bad price, and usually you miss even more with auto trailing. Now, manual trailing, you can do that. But here's the thing. You know, we have to consider that we send these trades out to our members, and our goal is to come out green. So yeah, we could have put a trailing stop perhaps on these daily lows. We probably would have been stopped out anyway on this pin bar low, unless we kept it here, okay? But that we would have given a lot back. At 13.25, we would have given a nice portion back. And we wanted to lock this thing in green. But to answer your question, yeah, you can use a trailing stop, but you have to be okay with giving a good portion of it back. This could have easily been a failed high, and it could have tapped us out. Okay, so we locked in at 14.09 and we got a decent profit out of it. And we missed it, okay, whatever, but keep something in mind, guys. Because I know we all want this and we see this and we're like, man, oh, I could have, you know, oh, yeah, trailing stop. I'll catch these every time. These are rare moves, number one. Okay, we're looking for consistency, not rarity, number one. Number two, you know, you have to be prepared for, I'm sorry, this move, missing this move, doesn't cost us anything. Our account did not shrink as a result of missing this move. Okay, we locked in green. Our trade was profitable. This money just wasn't ours to take. That's all. It wasn't our money. But we didn't lose anything. Our account didn't shrink. That's the way you have to think of this. Not, oh, I missed this. I could have had this. You have to look at the probability and, you know, the rarity of these moves. That's a home run. We don't know if the euro is going to do that. We're looking for consistency. Okay, I know I repeat myself. All right, anyway, so that's the answer there. Then implement the trailing stop on a portion of the trade. Well, you know, now the thing with Forex, the way, yeah, you could do that. You can lock in whatever, and then you can run. But again, that's really up to you. Another thing is we like to keep things as simple as possible because we have to make a lot of decisions. Remember, we're not just watching one market. We're watching a dozen markets. So we need to be able to decide things fast. And, you know, so we can't sit there and say, well, should I do this? Well, should I do that? Oh, I don't know. Maybe I will. Maybe I won't. I don't know. Okay, we can't do that. We just have to be like, okay, this, and move on to the next one. That, move on to the next one. This, because and people are depending on us to share these ideas in a timely manner. So we have a lot on our plate, right? So we need to keep things as simple as possible. So again, to answer your question, there's nothing wrong with a trailing stop. Just be prepared to give back a good portion of your move. That's all I'm saying. Okay? If you're okay with that, then, you know, then it's no problem. Trailing stops can also be more of a personal preference. You know, again, I just prefer, to just do things, you know, more manually and just waiting for the market to give me cues. Okay? Not getting too mixed up with like order entry this and order entry that and blah, 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 and this and that. Okay, so good question. Great question. All right, I'm talking too long. How much time have I been talking for? An hour and a half. I got to stop talking. You guys have any other questions? Did you guys like this webinar? Those of you on the YouTube channel that are watching this, give me a like if you like it. Make sure you subscribe to our Greenbridge Investing channel on YouTube so you can see I do videos throughout the week updating, technical points on Bitcoin and the major markets and stocks of your choice. Okay, brushing of the basics. Okay, cool. So yeah, all right. No, I know some of this may seem basic to people, but it's important to understand these things from that behavioral perspective. And that's really the key point. I want you to take away two things from today's webinar. And that is weighting the time frame. Okay, if you're not familiar with that, knowing how to weight your time frame, what is more reliable, and that these patterns all serve as a starting point. Okay, they're a starting point. They're not an absolute thing to do. They don't give you a specific trade idea. They don't really allow you to justify risk. They serve as a place to anticipate a change. And that's what I want you to take away primarily. All right, so I hope you found this helpful and insightful. Okay, good. Again, these webinars are geared more toward the less experienced trader. I know a lot of you guys like Ankit and DJ and the rest of you, you guys are always in my webinars and my videos that I do. So you guys know pretty much everything that I talk about. So you guys are more advanced. But people that are less experienced, a lot of these concepts, I know when I was new, I didn't even know how to read a chart. So these concepts would have been very helpful for me if I knew, why the double bottom works the way it does, not to think in absolutes, how to assign weight to these things. I didn't know any of that stuff. So I had to learn it the hard way. Anyway, so great. Thank you for watching, everyone. If I don't have any more questions, I'm going to wrap this up. I want to thank you again all for spending the time with me on a Sunday afternoon. Enjoy the rest of your day. And I will see you in the chat room, okay? Watch out for some new trades. We have some trade ideas on the radar. We'll see how that NASDAQ behaves tomorrow for the stocks. And Bitcoin, hey, let it ride. Let your winner ride, okay? Anyway, all right, everyone. Have a great day, and I'll see you next time. Okay, great, cool. Thanks for stopping by, everyone. Take it easy.